Welcome to my channel. I'm the cover call guy. My goal is to reach $120,000 per year in passive income using only cover call ETFs. My portfolio currently yields about $70,000 per year and about $6,000 per month. A legal disclaimer before we start. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Always do your own research and consult a licensed professional before making financial decisions. I'm just some random idiot you found online and I could be completely wrong. So please do your own due diligence and research. Today's video is going to be on WPAY from Roundhill. Is this the best weekly leverage ETF? Possibly. Don't know. We'll go through it. I asked myself 100 questions about WPAY and I did my research and this is what I came up with. So let's see if WPAY is the best weekly leverage ETF on the market. All right, section 1, we're going to identify its core identity and strategy. All right, what is WPAY, right? That's what we got to ask. What is WPAY? WPAY is a funds of fund, right? So what does that mean? The fund, WPAY, is a funds of fund. It holds 15 other single stock ETF. The engine behind this, these underlying ETFs use a 1.2x leverage swap. The funds of fund model, right? Pros and cons. The pros: diversification, instantly access a basket of 15 plus single stock strategy. The simplicity, one ticker WPAY instead of managing 15 plus different ETFs. What are the cons, right? Layered fees. You pay the fees of the funds inside the main fund, which is a double fee. And conflict of interest. The sponsor, Roundhill, can launch a new fund and have WPAY be a captive buyer. So that could be a bad thing, right? It could just means that they're funneling money into their own ETF, which could be no good, but the management team gets the expense ratio, no matter how it performs. The engine behind WPAY, right? How a total return swap works. This is the engine inside the underlying funds like NVDW. The NVDW fund holds investor cash as collateral. It pays a small financing fee to the bank. In return, the investment bank agrees to pay the fund 1.2 times total weekly return of NVIDIA stock. The fund gets the exposure to NVIDIA stock without owning it. Well, and this is just an example of how WPAY does it, right? WPAY underlying fund, NVDW, holds investor cash as collateral. Then they do pays financing fee, right, to the investment bank, which is the counterparty, which has exposure to NVIDIA stock. And so they're paying, and then they're doing a swap. The bank is giving WPAY some 1.2x leverage weekly return of NVIDIA. All right, the core contradictions that I found active versus passive when I was going through WPAY. They said that WPAY is passive, but is it really? The top level WPAY fund is passively managed. It mechanically tracks an index that tells it to buy all eligible weekly pay ETFs at an equal weight. Its holding are active, right? The underlying ETFs like NWDW are actively managed. A manager must actively manage the complex swap agreements daily to hit the 1.2 times weekly target, since this is a weekly payer. Then we go on to section 2, the distribution rate versus yield, right? The strategic opposite, WPAY versus cover calls, right? WPAY is leverage. It's aggressive and bullish. Uses swaps to get 1.2 times leverage. Has damn near unlimited upside. Versus a cover call like QYLD. Cover calls are somewhat defensive and neutral in nature. They sell options capping all or almost all upside for premium income. I put all because QYLD caps all, but I should have put a slash there. A critical misconception, right? Its reported distribution rate is 25.04%. Its actual estimated as of November 2025 is actually 0%. So what does that mean? Distribution does not mean income, right? A high distribution rate is not the same as a sec yield or income. What it distribute, the rate is a simple, non-standardized calculation based on the most recent payout, and the sec 30 yield is a standard sec formula for true income, dividends, interest, etc., premiums. Since WPAY underlying assets generate negligible income, its true yield is near zero. Basically, the source of the income is that pays out to you as your income is 100% return of capital. The entire distribution is classified as ROC. This is not a profit. It is the fund returning your own original principal. Well, is this good or bad, right? There is a trade-off to this. The good, you get cash flow today without paying taxes today. This is called tax deferred. The bad, it might not be real profit. It reduces your cost basis, meaning you have a larger capital gains to pay taxes on when you eventually sell. Tax implications. Holdings and composition. Right, all underlying holdings as of November 2025. The top 8 holdings are from Amazon, Google, Apple, Berkshire, I believe it's Berkshire, Nvidia, Broadcom, Microsoft, and Robinhood. And then the rest of the holding is AMD, Palantir, Tesla, Meta, Coinbase, MicroStrategy, and Netflix. Underlying sector exposure. The portfolio is heavily tilted towards high growth sectors. This breakdown is derived from all 15 underlying funds. Information is about damn near 50%. Communication is about 20. Financial is about 20. And consumer discrepanary is 14.1. Right. This creates a significant concentration risk. Oh, I cannot speak today. Jesus Christ. All right, we move on to section 4, performance and risk portfolio. Would you want to? Are you happy with the performance so far if you own it, and does it fit your investor portfolio? All right, funds vital and how liquid it is. Right, its inception date is September 4th, 2025. Analysts take it's a new fund. It's gonna be risky. Right, assets under management 550 million. Analysts take it's good. It gets a good rating. Successful launch. Average daily volume at almost 1 million. Analysts take good. Very liquid. Bid ask spread 0.10%. Analysts take good. Low friction. All right, we gotta look at this performance scenario. It is not a buy and hold stock in my opinion. Because it is leveraged, so this is a active trader. This is for someone who needs to or has to monitor the ETF every single day, right? So in a strong bull market, strong outperformance, right? Of course, you have the leverage upside, so you go up a little bit higher. Strong bear market, strong underperformance. As much as you can go to the moon, you gotta go back down too. And then in a sideways, flat, choppy market is a negative drag, right? Volatility decay and leverage reset. So this is for extremely bullish investors. All right, the structural risk that I found was, of course, there's leverage risk, right? What comes with leverage is being liquidated. So that is something you have to be careful. Right, magnifies gains and losses. A 10% drop in underlying assets could mean a 12% drop in the fund's NAV. Volatility drag. Weekly resets can erode the principal over time, especially in a choppy, non-directional market. Right, path dependency. It depends on the market going up and up and up and up. Counterparty risk. Right, the fund relies on swap agreements with financial institutions which carry their own default risk, like 2008. Or 2020 crash. Concentration risk. High exposure to a few tech stocks mean the fund's performance is tied to their specific fortunes. All right, the captive buyer conflict of interest. Roundhill launches a new fee, a new high fee 0.99 single stock ETF like ARM. The index add the funds, right? Because WPAY's index mechanically adds ARM as a constitute. WPAY must buy it. WPAY with 550 million is forced to buy a new fund, guaranteeing its seed money. So it's kind of like a pyramid scheme in a way, right? It has to and will buy the ETF no matter how it performs, no matter what the underlying is. Doesn't matter if it's good company, bad company, a fraudulent company. The WPAY will buy it, and if it doesn't perform well, the management got their cut, right, from the expense ratio. So investors for this fund or people that have it on a watch list, like myself, have to keep an eye on WPAY and see a good entry price. Other identified risk that I found was foreign risk. The index goal is global. That means WPAY holds funds like Alibaba, adding Chinese regulatory risk, right? I mean, look, in this environment under Trump, he could say, you know what, we're gonna remove all Chinese or foreign stocks, and then what happens, right? It could blow up the ETF. Prospectus warning. The prospectus for Coinbase especially notes that pending SEC litigation against Coinbase, a non-standard risk, a statistical risk. All stats drawdown on Sharpe ratio are based on less than 3 months of history in a bull market and are meaningless for predicting future risk. Right? WPAY has been formed and created, and inception date was during a really nice bull market, and we're technically still in a bull market. So WPAY is somewhat still doing well. However, in a prolonged downturn or in a choppy sideways market that trends a little bit down, we might not see WPAY survive, right? We might see the NAV erode so much that it's just not worth buying. The double fee structure, you pay the fees of the funds inside WPAY, not WPAY itself. And what I mean by that is you're paying the underlying fund fees, which is 0.99, and then the WPAY managed fee, which is 0.29. Right now, the fee for management is waived, so the actual expense ratio is 0.99. The 0.29 extra additional management fee is contractual and is in effect until I think September 30th, 2026. So after September 30th, 2026, that 0.29 will be added to the 0.99. Section 5, competitive landscape. We compared WPAY to YMAX, which is also a funds of fund, and you can see here WPAY does have some ups and some downs to it, right? The U scores is that it's 100% return on capital versus option premiums from YMAX. Upside potential is uncapped versus YMAX is capped. And again, the core strategy is it's different, right? Leverage versus synthetic calls. So as of the short-term result, WPAY is absolutely beating YMAX. Again, we're in a bull market and is leverage. So as the stock market goes up, you go up a little bit more with WPAY. All right, competitive two. Of course, I can't just do one, right? WPAY versus JEPQ and QYD. This is philosophy. JEPQ and QYD are not leveraged. They're also not weekly payers. I'm just comparing the philosophy, right? The strategy, the management, how they're trying to manage and handle these funds, right? WPAY is super aggressive, right? It's the bull. JEPQ is the defensive, and QYD is deep defensive kind of. I put deep defensive because it's at the money, and the philosophy is they're trying to pay out as much as possible. I don't know how they're gonna be doing with their NAV erosion, because they right now have some very bad NAV erosion. But you can see the upside, WPAY unlimited upside, JEPQ partially upside, and QYD fully capped. And then of course you see the yield source, how you're getting a yield and where the money's coming from. WPAY has return to capital. JEPQ is option premiums plus dividends. QRD is option premiums. All right, section 6, the verdict. Going off their perspective, right, their own perspective warning, the fund is not suitable for all investors. It is only suitable for knowledgeable investors who understand how the fund operates, and for those investors who actively monitor and manage their investments. Investors who do not understand the fund strategy should not invest in the fund, right? They're literally telling you, like I told you, you have to know what you're doing because it's a leverage ETF. You have to know what you're doing because you have to monitor it every single day, from when the stock market opens from 9:30 a.m. Eastern to when it closes at 4 p.m. Eastern time. Right? That is from their own management team, their own words. Investor suitability, the why, right? WPAY is targeted for investors who understand complex risks, right? The experienced guy of swaps and volatility decay and ROC tax implications. It's good for the short term bullish, right? It's not it does not do well long term, because in the long term there is down market and choppy sideways markets, right? And it should really only be in taxable accounts only. The main benefit ROC is only useful in a taxable account. It is absolutely redundant and useless in a 401k IRA, right? It is not suitable for retirees or income seekers because WPAY doesn't actually pay an income. It's 100% return of capital with extreme volatility, right? It's the opposite of a stable income fund. It's not good for a long-term buy and hold. Again, it's path dependency, has extreme volatility drag, and is mathematically guaranteed to erode returns in a flat or choppy market over time. And of course, if you have a tax advantage account, you get no extra tax benefit. It's just all risk. It would be dumb, right? You'll be a big dummy to do that. And of course, thank you. That is pretty much my deep analysis, my deep dive, my deep analysis on WPAY. If you found this analysis helpful, please like, comment, subscribe. And again, this presentation is for illustrative educational purposes only, and I based all the data on November 25 from what I can find. It is not financial advice. All investment carry risk. Please do your own due diligence, right? It's non-negotiable, especially when you're playing with leverage. Catch you guys on the next. Please give me a comment. Let me know if you would like it or not, or if it's good or bad, if you wanted more information. But this is all I can find so far. So enjoy. Catch you guys on the next. Thanks for watching.